The investment thesis for Flex LNG Limited, FLNG, is anchored in its position as a high-quality income vehicle within 7 vessels and an exceptional layer of contractual revenue visibility. These factors collectively mitigate the inherent cyclicality and capital intensity associated with maritime transport, supporting an aggressive yet strategically financed capital distribution policy. The core operational strength is derived from FLNG's 13-vessel fleet, which is entirely composed of modern, eco-efficient LNG carriers built between 2018 and 2021. These vessels utilize advanced two-stroke propulsion systems, specifically M-type, electronically controlled gas injection, MEGI, and Generation X dual-fuel, XDF, engines. This technological uniformity and efficiency provide a significant competitive moat, commanding premium time charter equivalent (TCE) rates and ensuring compliance with tightening environmental regulations. This superior asset quality translates directly into robust financial visibility. The company reports a minimum firm contract backlog of 53 years across its fleet, which could potentially expand to 80 years if all charterer options are exercised. This long-term revenue stream, estimated to be approximately $1.6 billion in contracted revenue backlog, functions as a powerful buffer against geopolitical shocks or fluctuations in the volatile spot market. Financial analysis of the Q3 2025 results reveals a duality in FLNG's financial structure. On one hand, short-term liquidity is demonstratively strong, highlighted by an all-time high cash balance of $479 million as of September 30, 2025. The company's balance sheet optimization program 3.0 has also proactively managed liabilities, extending the next significant debt maturity until 2029. On the other hand, the company operates with structural leverage typical of an asset-heavy shipping firm, necessitating a critical interpretation of standard solvency metrics like the debt-to-equity ratio and the Altman Z-score, which, if taken out of context, suggest undue risk. The persistent commitment to the $0.75 quarterly dividend, maintained for the 17th consecutive quarter, is the most prominent feature of the investment profile. The sustainability of this payout, despite GAAP earnings per share of $0.31 in Q3 2025 not covering the distribution, relies on a strategy of utilizing the accumulated contributed surplus account, leveraging the strong liquidity and dependable future cash flows generated by the long-term charter backlog. 2. The balance sheet, asset quality and capital structure resilience. A. Asset quality, the competitive moat of the fleet. FLNG's competitive differentiation is rooted entirely in its fleet composition. The 13 LNG carriers are uniformly high-specification vessels, all delivered between 2018 and 2021. The fleet's technological advantage stems from its reliance on two-stroke, high-efficiency propulsion systems, 9 MEGI and 4 XDF carriers. These engines are considered superior in fuel efficiency and carbon footprint reduction compared to older steam and 4-stroke propelled vessels, giving FLNG an edge in compliance and operational cost savings.
The high utilization rates and consistent performance metrics validate this asset quality. The technical uptime for the fleet in the third quarter of 2025, excluding scheduled dry docking periods, was reported at 99.5%. Such high reliability is crucial for fulfilling the terms of long-term time charters, which form the bedrock of the company's revenue stream. The successful completion of dry dockings for 2 vessels, Flex Amber and Flex Artemis, during Q3 2025 reflects proactive maintenance required to uphold this high operational standard, although these planned events did cause temporary pressure on quarterly revenues and adjusted EBITDA. B. Liquidity, debt management, and liability structure. The company's liquidity position is exceptionally robust. As of September 30, 2025, cash and cash equivalents reached an all-time high of $478.7 million. This liquid position provides substantial flexibility for operational needs and capital returns. Short-term solvency ratios further reinforce this strength. The current ratio is reported at a strong 2.84x to 3.1x, and the quick ratio is similarly robust at 2.81x. These figures indicate that FLNG is well equipped to manage its near-term financial obligations comfortably. FLNG has executed a well-managed program to optimize its capital structure, identified as Balance Sheet Optimization Program 3.0. This strategy successfully secured $530 million in new financings during 2025, releasing $137 million in capital, and most critically, pushing the next major debt maturity wall out to 2029. Specific transactions within this program included signing a $180 million term loan facility for the Flex Constellation with attractive terms, SOFR plus 165 basis points, and completing a $175 million sale and leaseback agreement for the Flex Resolute. This proactive management of the debt portfolio not only enhanced liquidity, but also significantly de-risked the company's long-term financing requirements. Despite this strong liquidity, FLNG maintains a significant total liability profile, amounting to $1.86 billion at the end of 2024. Consequently, the debt-to-equity ratio is high, ranging between 2.37x and 2.54x. This high leverage is characteristic of the maritime transport industry, where massive upfront capital expenditures for vessel acquisition are financed primarily through debt. Supporting the view of sound asset investment, the company's book value per share has seen significant positive progression, climbing to $15.01 in 2024 from negligible levels in 2017, affirming the successful accumulation of high-value assets. C. Contextualizing solvency risks and the Altman Z-score. A technical review of traditional solvency metrics yields a striking contradiction that requires careful sectoral interpretation. Standard models such as the Altman Z-score register FLNG at an alarmingly low level, reported between 0.84 and 0.86. This reading statistically places the company in the distress zone, typically implying a high probability of bankruptcy within 2 years. However, in the context of capital-intensive asset-backed maritime firms, the Z-score often functions as a false negative. The metric disproportionately penalizes high levels of fixed assets, vessels, and long-term non-current debt, which are necessary components of FLNG's operating model. Furthermore, the Z-score relies heavily on retained earnings and working capital ratios, which can be temporarily skewed in the shipping sector by non-cash accounting charges like depreciation and amortization, or by strategic dividend distributions drawn from equity rather than current earnings.
A more relevant solvency indicator for this industry is the net loan-to-value (LTV) ratio. FLNG reported a conservative LTV ratio of 54.1%, demonstrating that the company maintains a substantial equity cushion, 45.9%, relative to the underlying value of its assets. The combination of long-dated, attractively priced debt with maturity extended to 2029 and the stability provided by the enormous contracted cash flow backlog fundamentally validates this debt structure, proving that the quality of the leverage is high, mitigating concerns raised by the statistically misleading Z-score calculation. III. Cash flow generation and contractual stability. A. Operational performance and EBITDA stability. FLNG's financial performance is defined by its ability to convert high-quality assets into stable, high-margin cash flows. Q3 2025 exhibited robust, albeit slightly tempered operational results, with vessel operating revenues reported at $85.7 million. This figure was marginally down from the $86.0 million reported in Q2 2025, primarily due to temporary factors, including the aforementioned dry dockings and one vessel trading in the spot market. Adjusted EBITDA for the quarter stood at $61.2 million, which represents an exceptional EBITDA margin of 76.72%. This high margin confirms the economic benefit of the company's business model. Securing long-term time charters transfers the majority of variable operating costs, such as bunker fuel, to the charterer, allowing FLNG to capture a large share of the gross revenue. Looking forward, the full year 2025 adjusted EBITDA guidance is strong, projected at $250 million. B. Free cash flow proxies and distributable earnings. A significant divergence exists between FLNG's reported GAAP net income and its cash-generating power. Q3 2025 net income was $16.8 million, resulting in a basic earnings per share EPS of 0.31 cents. However, after adjusting for non-cash items such as annualized losses on interest rate derivatives and financing write-offs, the adjusted net income rose to $23.5 million, producing an adjusted EPS of 0.43 cents. This material difference underscores the importance of focusing on adjusted EBITDA or similar metrics for assessing distributable cash flow in this sector. The required depreciation and amortization charges on multi-billion-dollar vessels significantly depress GAAP profitability, meaning the statutory net income substantially understates the economic cash flow available for discretionary distributions and capital reinvestment. The forecast of $250 million in annual adjusted EBITDA confirms a reliable, consistent stream of operational cash flow that far exceeds the dividend requirement. C. Commercial flexibility and market exposure management. The 53-year aggregate contract backlog provides high revenue predictability and minimizes exposure to the volatile short-term LNG shipping market. For the immediate period, the contract coverage is 92.2% for the remainder of 2025. However, the portfolio is beginning to see calculated risk exposure. The company received notice that a charterer would not exercise a one-year extension option on the Flex Volunteer, leaving the vessel open from mid-January 2026 after its scheduled 5-year special survey and dry docking. This event has been characterized by management as causing a small adjustment in internal decision criteria for the dividend policy scorecard, shifting the backlog visibility metric from a high assurance level, dark green, to a slightly reduced certainty level, light green.
Management has articulated a disciplined commercial strategy regarding vessels coming off charter, such as the Flex Volunteer. The objective is to utilize the strength of the balance sheet and record cash position to trade these ships in the spot market until term charter rates rebound to levels commensurate with the quality of the modern fleet. This patience is underpinned by the structural positive outlook for the LNG sector, driven by record final investment decisions, FIDs, for new liquefaction capacity in 2025, which sanctioned nearly 70 million tons per annum, MTPA, of additional capacity. This long-term growth in supply is expected to translate into strong demand for high-specification carriers, validating the strategy of avoiding premature long-term commitments at depressed rates. IV, Dividend Safety and Financial Engineering Assessment. A, the dividend coverage gap and payout ratio. The cornerstone of FLNG's investment appeal is the quarterly dividend of 75 cents per share. The maintenance of this distribution, however, creates a significant coverage gap when measured against standard earnings metrics. In Q3 2025, the 75-cent payout dwarfed the GAAP basic EPS of 31 cents. Even when utilizing the more generous adjusted EPS of 43 cents, the dividend remains uncovered by current quarterly operational profits. External analysis confirms this substantial disparity, citing a quarterly dividend payout ratio of 1.43x. This ratio highlights that the company must tap sources other than current retained earnings to fund the full distribution. B, the mechanism of contributed surplus. The safety and continuity of the dividend hinge on a crucial financial engineering mechanism, the use of the contributed surplus account. The board explicitly declared that the Q3 2025 cash distribution would be made from this account, which represents previously paid-in share premium transferred from the additional paid-in capital account. This practice signals that the distribution is, from a financial accounting perspective, a return of capital, ROC, rather than a distribution of current retained operating earnings. This is a deliberate, strategic choice by management, prioritizing the maintenance of a stable, high dividend yield for shareholders over strict coverage by quarter-to-quarter GAAP metrics. The ability to execute this strategy is directly linked to the company's exceptional liquidity position. The $479 million cash balance provides the immediate means to make the cash distribution. The long-term sustainability of this practice is secured not by quarter-to-quarter earnings, but by the reliability of the long-term contracted cash flows. The massive contractual backlog acts as a guarantee that the capital base utilized for distributions will be reliably replenished by future cash generation, provided the company executes its contracts effectively. For U.S. investors, the company's structure as a Bermudian C corporation simplifies tax reporting, furnishing a Form 1099 instead of a K-1, a detail that often enhances the stock's appeal for income-focused institutional and retail investors seeking ease of reporting. C. Strategic rationale for capital allocation. The maintenance of the 75-cent dividend, despite the slight reduction in contract visibility flagged by the Flex Volunteer non-renewal, demonstrates a strong management conviction in the forward cash flow cycle. Management's decision to continue distributing capital rather than retaining it to improve the DE ratio indicates a belief that the current operational cash flow, supported by the balance sheet, is sufficient to fund both distributions and required capital expenditures, CapEx, primarily dry docking costs. The choice to distribute capital is a conscious affirmation of the company's focus on shareholder returns, suggesting that management views internal growth opportunities, such as potential new vessel orders, as being either suboptimal currently due to high new build costs or adequately funded by existing facilities.
V. Valuation relative to peers and intrinsic value. A. Equity and enterprise value multiples. An analysis of FLNG's valuation metrics based on Q3 2025 figures suggests the stock is currently trading within a zone of moderate undervaluation relative to its potential. In terms of equity metrics, the price-to-earnings PE ratio for December 2025 is reported at 14.20x. When evaluated against proprietary intrinsic valuation models that factor in unique growth prospects and risk profiles, the calculated fair ratio ranges between 16.5x and 17.5x. The discrepancy between the current multiple and the calculated fair value implies that the stock may be moderately undervalued, offering a discount on current earnings given the company's secure future growth prospects. The price-to-book PB ratio of 1.89x reflects a premium over the accounting value of assets, justified by the specialized high-demand and contracted nature of the modern LNG fleet. From an enterprise perspective, the 2025 estimated EV to EBITDA multiple is 11.56x. This is slightly higher than the 2024 low of 9.95x, but aligns closely with the company's historical 5-year median of 11.2x and average of 11.7x. This consistency suggests the market is pricing FLNG as a stable operating company whose valuation is anchored by its predictable EBITDA generation. B. Peer group contextualization, carrier versus infrastructure. Contextualizing FLNG's 11.56x EV to EBITDA multiple requires a careful distinction within the broader LNG energy sector. FLNG is classified as a pure-play LNG carrier, deriving highly stable, fixed-rate revenue from transporting the commodity. Its valuation reflects this utility-like stability and predictability. In sharp contrast, companies focused on LNG infrastructure development, such as floating liquefaction (FLNG) and regasification terminals, trade at significantly higher multiples due to their perceived growth trajectory and higher commodity exposure. For instance, Golar LNG (GLNG), an FLNG infrastructure developer, reported an LTM EV to EBITDA of 93.5x as of October 2025. Similarly, New Fortress Energy (NFE), an integrated energy infrastructure company, reported an LTM EV to EBITDA of 84.4x. The massive discrepancy in valuation multiples is rational and structural. FLNG offers lower commercial risk due to its high-quality, fixed-rate contracts and standard asset configuration. it is appropriately valued as an operational income stream, whereas GLNG and NFE are valued as high-growth infrastructure plays, bearing greater development risk but offering exposure to potentially higher returns driven by commodity-linked upside and ambitious expansion projections.
C. Analyst sentiment. Analyst coverage for FLNG is thin, but the consensus is currently a uniform hold. This consensus suggests that the market has fairly balanced the known operational security, robust backlog, strong liquidity, against the structural risks, high leverage, near-term contractual exposure for 2 vessels in 2026. The reported consensus price target of $23 supports the assessment that the company is currently fairly valued, following a strong historical 5-year total shareholder return of over 523.4%. The current valuation is likely experiencing some compression due to the known market exposure of the 2 vessels becoming open in 2026, leading to a temporary reduction in fleet-wide contract visibility. The current multiple is appropriate while the market awaits clarity on the securing of favorable long-term rechartering agreements, which would solidify the long-term cash flow profile and justify a return to the higher end of the historical trading range. VI. Conclusion and detailed risk analysis. A. Investment thesis synthesis. FLNG maintains a solid investment profile characterized by high operational security and superior asset quality, making it a compelling candidate for income-focused investors. The company's resilience is built on the long-term nature of its charter contracts, 53 years firm backlog, and its technologically modern, fuel-efficient fleet, MEGI XDF propulsion. The successful execution of its balance sheet optimization program 3.0 has extended debt maturities and maximized liquidity, creating a substantial cash buffer, $479 million. The decision to maintain the 0.75 quarterly dividend, even when quarterly GAAP and adjusted EPS fall short, is a strategic allocation of capital, demonstrating management's high confidence in the predictable future cash flows generated by the contracted backlog. The use of the contributed surplus account is a conscious financial choice to utilize equity buffers to smooth payouts, rather than a signal of fundamental insolvency. B. Structured risk assessment and mitigation. 1. Market and operational risk. Risk. Near-term revenue stability faces potential pressure from fluctuations in spot market rates, highlighted by the decision of a charterer not to renew the long-term option for the Flex Volunteer, leaving it open for mid-January 2026. Furthermore, the industry faces an influx of new LNG vessels, which could compress charter rates. Mitigation. The risk is contained by the high contract coverage for the remainder of 2025, 92.2%. Management's disciplined commercial strategy to place vessels in the spot market only temporarily, while awaiting favorable long-term contract opportunities, is supported by strong structural tailwinds. Global LNG demand is forecast to increase significantly, 60% by 2040, and record FIDs for new LNG liquefaction projects in 2025 underpin the expectation of strengthening demand for carriers in the mid to long term.
2. Financial risk and leverage. Risk. The high debt-to-equity ratio, up to 2.54x, and the statistical warning provided by the low Altman Z-score, 0.84, suggest elevated financial risk. Mitigation. The high leverage is structurally necessitated by asset ownership and is manageable given the company's conservative net loan-to-value ratio, 54.1%. Debt maturity has been proactively extended to 2029, eliminating near-term refinancing pressures. The revert cash balance provides a critical defense layer against potential operational or financial shocks. 3. Dividend sustainability risk. Risk. The substantial dividend payout ratio, 1.43x, and the reliance on the contributed surplus account raise concerns about long-term sustainability without corresponding growth in operational earnings. Mitigation. The dividend is secured by the certainty of the future contractual cash flow stream, evidenced by the $250 million FY 2025 adjusted EBITDA guidance. The use of equity buffers for distributions is a calculated financial policy, justified by the fact that reported GAAP earnings are significantly depressed by non-cash charges inherent to the sector. C. Final investor positioning. FLNG should be viewed as a high-yield, low-volatility investment within the energy transport sector. The high dividend, while not strictly covered by current GAAP earnings, is fundamentally backed by long-term contractual security and robust liquidity. The current consensus hold rating and fair valuation suggest the immediate upside is limited until the market gains certainty regarding the rechartering of the open vessels in 2026. For investors prioritizing reliable income and asset quality within a high leverage model, FLNG's strategic positioning provides substantial assurance against typical shipping sector risks.